In this week's update, US earnings going well. A good week to sit on the hands. Bitcoin ETF starts trading and precious metals remain in limbo. My name is Garry Davis and as always this is general advice only, and please remember to like and subscribe the video. Alright, let's start with some market perspective. We're into the second week of US earnings and so far they're going well, and the S&P has set the umpteenth new all-time high, record high, never been there before. And so all the people that are worried about the market having run too far too fast are missing out again. So the message this week is, if the primary trend is in place, and clearly it still is with most sectors and many stocks, then don't worry about the short-term gyrations. We haven't had anything greater than a 5 or 6% pullback in the S&P index since March of 2020, or since February of 2020. So it's been a terrific advance, and there's still really no sign that it's coming to an end. And all this anxiety about the market must correct because it just feels like it should is just wasted energy. And far too much energy and far too much money gets lost by people trying to stay safe, trying to avoid the next correction. And I remember reading this quotation probably 30 years ago by a legendary US trader called Ed Seykota. And he said, one cannot keep breathing in without breathing out, meaning that you've got to take, if you're making 2 steps forward or 3 steps forward, then you can't avoid taking 1 step back. You just can't keep breathing in all the time. You've got to give a bit back to the market to stay in the primary trend. And yet I see today so many commentators and so many investors who seem to want to try to avoid the next little correction, like a 5% correction is some, life-threatening event. It's just not. It sells a lot of media time, but it's not actually a productive way to think about the market. So I'd really encourage you to tune out to the people out there, the commentators and others who I think just hate success. People who are permanently bearish, I think they just hate success. And the performance of the US and the Australian markets must be rather annoying to these perma bears out there who are probably a bit cross because maybe they've been on the sidelines since March of 2020, I don't know, convinced that the sky was falling in. And I get the odd bit of abuse from these people who are nothing more than internet trolls, to be honest, that hide behind fake names. I feel pretty sad for them, really, because the overwhelming weight of evidence continues to support this secular bull market for another decade. Now, that doesn't mean there won't be some cyclical bear markets. There will, and pullbacks of 20, 30, 40, or perhaps even 50% are possible, but that doesn't change the secular trend which has been in place since 2013. And I wish to thank all the investors, while I'm on this topic, who watch this video for your words of support and appreciation. I really do appreciate that, and it's one of the reasons that I do it. And I've done this for over 15 years. I've roughly done something in excess of 700 of these Sunday updates. And at the moment, I plan to continue doing them, internet trolls aside. So let's move on. Let's look at the American market. The S&P was up 1.65% for the week. Set a new all-time high in the process. Looked a little shaky on Thursday night, I thought, but with a breakout that didn't really go on with it. But Friday night finished okay enough. We've seen 99 companies so far in the S&P 500 report. 89 of those 99 companies have beaten on earnings, and 13% have raised guidance. And 13% is a pretty robust number. When things are going well and you're in a bull market, American CEOs, it's not smart to raise expectations too high. And so they traditionally play this game of under forecasting and then beating it, and everybody cheers and everybody's happy. And that's the game that's been going on Wall Street for decades and decades. So the fact that 13% are raising their guidance when they don't need to, this is not a bear market. We don't need to talk stock prices up. Just shows you the confidence that is behind the American market in particular. Now, when we look at the financial year 22 outlook for earnings, it still supports a continued bull market. There's really no other way to carve it in this low interest rate environment. But look, a short-term breather would be helpful, and the week that we're just about to start is traditionally, if you look back over the last 50 to 60 years, this final week of October is one of the weaker weeks of the year, almost bar none. So a short-term breather would be pretty good, and hence my opening comment that, maybe just sit this week out, just sit on your hands for a week. You're not going to miss out on anything terribly much. Might be a prudent step, because it's just possible that, if there is a little bit of a pullback in the market, that you'll get some better entry prices. Now, the US dollar eased a little bit further down to 93.61. We saw the 10-year yield rising to 1.64, and that's kept a little bit of relative pressure on the technology sector, which, underperformed, not by much, but, enough to be noticeable. And the VIX is now down at 15.5. So let's go and look at some charts. We'll start with the S&P. You can see new all-time highs, pretty indecisive. It was roughly a flat finish on Friday. But things looking pretty good in America, and particularly with earnings going as well as they are. Any sort of pullback should only be quite shallow and fairly brief. If we look at small caps, however, small caps have been stuck in a range since February of this year. So that's 8 months now. But I would tend to think the way that earnings are going, that it may not be too long before we see a breakout in the small cap space in America. Now, if you look at some of the key spread charts, the key one I want to look at is this is consumer discretionary against consumer staples. And, this is a very, very powerful breakout. Now, helped a bit by a couple of big stocks. So Netflix has had a great run. Tesla, I think, is also in the consumer discretionary sector, I think. I'm not sure if it's industrials or consumer discretionary, but it's possible it's in this one. So they're certainly helping, but there's a lot to like about what's going on in the consumer discretionary space. And there's no question when consumer discretionary is outperforming to this degree that the market is in a pretty healthy state. All right, this is the small cap growth versus small cap value. Not a lot has changed during the week. And this is the large caps growth versus value. Not much has changed there either. So turning now to the currencies. So the US dollar is yet to make this move up. We're in a short-term uptrend. Medium term, we're going sideways. And we need to get to above 94.7 to break out and start to move higher towards those all-time highs. So at the moment, we're still printing higher highs and higher lows. So the US dollar is in uptrend. The Australian dollar has probably outperformed. It's probably done a little bit better than what the US dollar would dictate because commodity prices have been so strong. And so that's supported the Australian dollar, which closed at 74.12. Now, the ASX 200 index was up 0.7 for the week. Battery materials just remain the killers. They're the ones that are outperforming. Lithium stocks are doing well. Uranium stocks are doing well. So it's certainly the star performers in the Australian market are definitely the mining stocks in those particular key areas. So let's take a look at all those indices. So the ASX 200, we're still comfortably off the highs. The highs were just above 7,600. We closed the week at just over 7,400. So we're down about 200 points on the peak. A lot of that is due to materials. So the major iron ore miners have certainly weighed heavily on the indices. Energy had been strong, but you could see got sold off quite sharply over the last 3 days, and elevated volumes as well. Finance continues to just slowly grind higher, and healthcare has also had some consolidation as well. And if we look at the Australian small caps, it's still trending very nicely. Just while I think of it, on Bitcoin, Bitcoin broke out to new all-time highs, got up to 66,000, but pulled back on Thursday and Friday, and is now back into the range. So whether this proves to be a failed breakout and we then get a move, perhaps all the way back down here to 50, 52, 52 and a half, that would sort of make sense from a purely technical point of view. Now, during the week, I'm sure if you're involved in cryptocurrencies, a new ETF started. People have been waiting for this for some time. BITO started trading, and that's what it looked like. So it traded for 4 days, bit of a roller coaster. It looks pretty volatile, but this is quite a compressed scale. But just a bit of a word of warning here. If you're used to buying ETFs, but not ETFs that are based around futures, which my understanding is this one is, the disadvantage of a futures-based ETF is that every month the ETF manager has to roll the futures contracts out to the next month. And every time they do that, that incurs a cost, which is a drag on the value of the ETF. And so it's akin to swimming into the current when you're in a rip. And so theoretically, a futures-based ETF should underperform the Bitcoin price by around about 10% a year. That's about the impact of that futures roll. So just have your eyes open to that fact. It's going to underperform Bitcoin over the long term. All right, while we're here, we'll look at precious metals. This is the daily. We got a short-term higher high on Friday, but it pulled back again. And if you look at the weekly, we got to the top of the channel, but we still haven't got out of this downtrending channel yet. Now, I am completely neutral on precious metals. I've been bearish at various times in the last 2 or 3 months. At the moment, I'm neutral because we've moved back to the top of the range, but I'm certainly not turning bullish at this stage because it hasn't broken out. We still do not have higher highs on a weekly basis. And if we look at silver, it's really showing up pretty much the same way. We just haven't been able to get up and form that higher high yet. And if we look at SLV, so the bearish case has been weakened. There's no question about that. We had a breakdown of this support. We rallied back to it. Then we formed a lower low, rallied back, and now we've broken back into the range. So the bearish case is weaker for sure. But at this point in time, it could still go either way. So I'm absolutely neutral, have no opinion on the short-term direction. And if we go to GDX, it looks very similar. So again, this is a failed breakout. And sometimes failed breakouts can lead to more selling than would otherwise be the case, because it draws in, on the breakout, it draws in traders who have been waiting to see which way it went. And then when it fails, those traders have then got to reverse their position. And so you end up with a greater downdraft than would otherwise be the case if the price hadn't ever broken out. And you can see there was some significant volume on Friday. Now, it's indeterminate whether that volume was on the up or it was on the down. You'd need an intraday chart to determine that. But again, this just reinforces what I'm saying about the sector. Just be a little bit careful and, don't take a view on it at the moment because it's just not warranted. So we've pretty much gone through that. Gold, 1793, and GDX short-term breakout, which then failed. Moving to other commodities, copper went down to 443, nickel went down to 897. Now, that was probably a bit unexpected because the US dollar also eased a bit. But look, what happened last week is that China was pretty active in the futures market, particularly in coal, in trying to bring down all commodity prices, and it would appear that they've had some short-term success. But the long-term position for these materials is still very bullish. Now, crude oil still rising, almost to $84, and I guess the situation here is that this extraordinary drive to go green as fast as our fat little legs will carry us before the alternative is ready, because as enthusiastic as you might be about wind and solar and other renewable energy sources, it's just not ready to provide baseload power. It just isn't. And so what's happening here is that because of this drive to go green, so many of the major oil companies are not reinvesting sufficient to produce more production. They're engaging in share buybacks and higher dividends, so they're returning money to shareholders because it's just not considered good corporate activity to be reinvesting in the development of production of fossil fuels. And so what's happening is we've got demand is not rising, but it's not falling that much either. Demand is fairly flat, but supply can't keep up. And so the oil price just continues to rise. And it's really hard to see, while this extraordinary drive to go green remains, that the oil price is going to cool off anytime soon. So, you'd have to say that $100 oil plus is now definitely in play, for sure. And also uranium and lithium continue to show, pretty good strength as well. So lots of good things happening out there. There's the spot copper chart, so you can see how sharply it came off in the last week or two, and the same with nickel. So my final thoughts: if you're worried about the next correction, and I pick up on this because I get questions and I see commentary from analysts, and I read commentary from investors asking questions. If you're worried about the next correction, then one of two things is happening here. Either your thinking is not very clear in this current market that we're in, because worrying about the next correction when you're in a secular and cyclical bull market, I can't understand why you would do that. Or your strategy is not clear. You're not really clear about what is your purpose, what is your time frame, all of those sorts of things. Corrections, large and small, are to be embraced when you're in a bull market. That's it. We keep forming higher highs and higher lows. So corrections are a good opportunity. And in 35 years of being in the market, I can't remember a time of greater opportunity. So I don't know what people are concerned about. I think it's only just the length of time that this has been running, and the fact that we keep setting new all-time highs seems to have people worried. But it's what a bull market does. It'd be strange if it wasn't happening, is the way to look at it. And I think there are too many people out there who are just making up a story. They've got a bias in their mind. In their mind it's valid. I'm not being critical here, but they've got a bias, and they're just making up a story to fit their bias, and they probably don't even know that they're doing it. So my message today would be to encourage you to try and catch yourself out, not thinking clearly about what the market is actually telling us. Because at the end of the day, it doesn't matter what you think or what I think, it's what the market does. And that's all encapsulated in the charts, and that's the end of it, end of story. Our portfolio analyst last week, we covered iron ore stocks in China, which is a very interesting unfolding story, to say the least. And there was another new addition to the portfolios in that service. So that's it for this week. If you'd like more information, There is some on the website, and there is my email address for anyone that would like to contact me. So that's it for this week. I'll be back with you next Sunday. Cheers.